Good morning, everybody. Can everybody hear me? Well, first of all, I'd like to say that I'm humbled as a K through 12 person being in this room with this audience this morning. Jim and Enrico, fantastic papers. I think that I spent a lot of time reading them and giving them some thought. By way of background, I am Jonathan Grable, the CIO for Montgomery County, Maryland, not Pennsylvania, Public Schools. We are a big public school district. We don't just think of ourselves as being a big district, we think of ourselves as being able to deliver excellence in a scalable manner, and part of that is making sure we have the right compensation structure for our staff. And as such, I oversee a $1.2 billion defined benefit plan and about a $1.1 billion defined contribution plans, plural, in a 403B and 457B plans. And from the perspective of what are relatively small plans with relatively limited resources, that's kind of the frame of reference from which I looked at the papers. There's no need for me to rehash what Enrico went through, but I thought it was a very interesting paper. I think that it's very true from my perspective that plan sponsors are more and more focused on the liability side of the house. I think everybody I talk to in my seat in different plans talks about risk since the great financial crisis. And I think that people are doing that, across the continuum, and the paper talks about this of from plan design to plan closures to transferring risk to better managing risk from an investment standpoint. The paper talks about LDI as well as different financial solutions. What I thought one of the most interesting things in the paper was nomenclature. I think that there's a chart in the paper that talks about how different plan sponsors or different people define LDI differently. So it's really hard to have a consistent application of something if you're defining it differently. And I think maybe that's half the battle. But I think the regulatory challenge is something that, as a small plan, that I'm always worried to is adverse selection. I think maybe by the time something makes it to my office in Rockville, Maryland, it may not be on the cutting edge. And maybe that continues all the way down to the alignment of incentives. In terms of observations from the paper, I'll go through them quickly now. First, in terms of plan design, plans definitely are changing. I know our plan has changed dramatically. I've been with Montgomery County Public Schools since August of 2011. Our plans are changing from both an asset and a liability perspective. From the employees are contributing a significant amount. Beginning in July, 2011, all plan participants now contribute 7.5% of salary, pre-tax salary, to the plan. That really creates goal congruence and makes everybody truly a partner in making sure that there's a better outcome. But it's also harder to participate in that vesting is now a minimum of 10 years. There's a lower payout ratio, and not that we have a hybrid with a DC plan, but we offer both, and more and more plans are changing. And I think ultimately it's not going to pay off in the short term, but long term, as plan design change, there is a big risk mitigation aspect to that. From a risk management perspective, from the asset side, there's a whole, I think I used the word before in a prior slide, continuum. It basically goes down the list, from more strategical to tactical, from diversification. Everybody talks about alternatives, all the way down to a GTAA approach. I know we do not do an LDI approach. I think it's difficult in this interest rate environment, also given our funded ratio. But we've certainly are looking at risk parity. I guess is a broader term where I don't think all risk should be equal, but we're more looking at risk factor-based analysis that not just allocates capital based upon market weights, but upon risks. We've implemented overlays as it relates to better managing cash and also better rebalancing our plan. I think, and especially for a smaller plan, it really creates a debate. Do you want to insource or outsource some of these functions? I know bigger plans are insourcing, smaller plans, maybe outsourcing. But for some of these strategies, for certain tail risk hedges, I might be a seller as opposed to a buyer. Just because I think at many times we're fighting the last battle, the last war, as opposed to the next one. Other variables, obviously our funded status, the low interest rate environment, and I think one of the challenges is, we've recently conducted an asset liability study. In the process, for our non-risk seeking assets, we are in the process of shortening the duration with the belief that that may be a higher Sharpe ratio associated with that. But is that in conflict with our actuarial assumption, which is remaining static at 7.5%? Does that increase not risk seeking, but the risk burden of the risk or the growthy assets in the plan? Implementation for these different strategies is difficult. It really is a function of plan resources. Certain strategies are very difficult to do with limited staff. I think one of the imperatives relates to benchmarks and monitoring, in that so much of the industry, from a plan sponsor perspective, is focused on relative return and comparative return to other plans, as opposed to what the absolute return is and what the actuarial assumption is. I mean, to me, my primary benchmark is that 7.5%. I need to beat that. If I don't, there's an externality associated with that. One of the other things that I think is an imperative, or something that is something really that we need to talk about, is just fees. Fees eat into returns. There's a J curve in that. And over a 30-year period, reducing fees 10, 20, 30, 100 basis points, I don't know what the number is, really adds up. And I think it's something that we as an industry can benefit from. The second paper I thought was equally interesting. I'm trying to be somewhat political, but I think that, obviously, long-term market returns have critical implications. For a school district like us, it impacts staffing, it impacts physical plant, it impacts, books for the students, class size. And it's something that is very important. Also, our ability to attract talent. I think that the different models that were presented in the paper are very interesting. I like how it's evaluated in the context both of DB and DC plans. I think DC plans have fewer resources associated with in terms of evaluating planned outcomes. Some observations from the paper. The first is I love this commercial from AT&T. I think they've got great creative, and that big data, more information. Is more information better? In theory, yes. However, in practice, it may not be. It's really important to make sure that the data is usable. And I can go on, maybe high five, like he does in the commercial, but I think that the real takeaway is it needs to be usable. The context, and I'll put kind of a slightly different hat on, not as a plan sponsor, but for 12 plus years or so before joining Montgomery County Public Schools, I was a general partner in a private equity firm. And in the process, probably looked at over 1,000 models. None were right. Not one. And whether one was off by more than another, it wasn't necessarily predictive. While I didn't regress the data, it really wasn't predictive. The one thing that models are precise, the math works. It helps you identify trends, test scenarios, but I think it's important to use multiple models for multiple purposes. Once again, in the PE perspective, sometimes it was better using a back-of-the-envelope model to basically just look at gross margins and gross profit and contribution margins. That may have been more applicable to outcome than kind of that 50-page leverage buyout model. So my real take on it is models are necessary but not sufficient. You really need to marry it with judgment. From implementation standpoint, I think I just said that models do add rigor to a process, and that's really important. It takes some of the emotion out. And once again, the models need to be very user-friendly. Now, going back to the perspective of that of a plan sponsor, it's important. We run lots of models, work with our consultants on lots of models. It's really important to understand what the role of a specific model is. Is it for asset allocation decisions? Is it for manager selection or termination purposes? Is it for funding purposes or rebalancing purposes, it's really important to understand. But likewise, it's important to balance it with qualitative analysis and factors as well as judgment. And like with the prior paper, a similar point is resources. Resources really impact the ability to work with different models and different templates. It may require not just more people, but different skill sets among staff. And one of the things that we are doing in this is not just working with our investment consultants, but working with our investment managers more in kind of a partnership basis. Now, some general observations about the two papers. Both talk about asymmetric risks in retirement plans and ways to mitigate it, and managing a plan in the context of uncertainty. But once again, I think that it needs to be tempered with the fact that there are risks in what I'll call a left tail mindset. You have the potential for underperformance if you make your allocation decisions just looking in the rearview mirror. The future will be different. And I like analogies. So you can't just win the game by putting in the prevent defense. You can't win the war by stationing a lot of tanks in Germany. It may not work going forward. So I think that it's important, but it really needs to be tempered with some other expectations, and those expectations need to be realistic. We have to be really honest with respect to investment rates of return. Many plan sponsors focus on knocking the cover off the ball, really searching for alpha. Maybe it's better from a plan perspective, from a total stakeholder perspective, to have more bounded returns where you potentially give up some of the upside, not to have massive drawdowns. And I think getting beta right, may be the right thing. There are tremendous financial innovations. There will always be market efficiencies. Back to my earlier point about fees, I think that there really are smart beta options out there that are emerging. Fee structures will change. A couple other final points are, and once again, as a small plan, I'm always concerned with agency issues. I think that you have to understand the motivations of the people that are coming in, quote unquote, to help you. You have to understand what their business model is and how it is consistent or inconsistent with what your goals and objectives are. In order to do that, we really need to expand financial literacy amongst everybody, all stakeholders. I think part of that really is, and something I know we strive for with our plan, with our pension plan, is good governance. We have added to our board of trustees people with more financial backgrounds, and it's made a really big impact on the level of discourse at our board meetings. The one final thought is that many of these risk mitigation strategies are much more difficult for defined contribution plans, especially where participants self-direct the allocation of monies. This is we'd be lucky if we get people just to focus on asset allocation decisions where public plans were maybe a decade ago, let alone risk mitigation strategies. And with that, thank you.